Welcome to Investing Insights. I'm your host, Sarah Hansen, filling in for Ivana Hampton today. One of the buzziest terms on Wall Street right now is concentration. For the past 2 years, the lion's share of the stock market's returns have been generated by just a handful of mega-cap tech companies. A highly concentrated market like this can and has turbocharged returns, but it also carries downside risks. Here to walk us through what it all means for investors is Dominic Pappalardo, Chief Multi-Asset Strategist for Morningstar Wealth, which is part of a registered investment advisor, Morningstar Investment Management. Well, Dom, thank you so much for being here.
Great to be here, Sarah. Thanks for having me.
So let's talk about concentration risk. What do strategists mean when they say concentration risk?
Yeah, it's a topic that comes up every so often, and really the crux of it is that the largest names in the stock market indices have built up to represent an outsized portion of the index. So for example, the S&P 500 names in the index right now, the top 10 companies make up roughly 40% of the market cap of that index. So when an investor buys what they believe and what is advertised as a diversified index is really not as diversified as they might expect it to be.
So we have a pretty concentrated narrow market today. We mentioned tech stocks at the beginning. How did we get here? What forces brought us to this point?
It's an interesting set of circumstances that has to materialize. And it's really a function of those largest names have dramatically outperformed the broad market over the last, let's say, post-pandemic period. And as their market value increases, the stock price is going up, they represent a larger and larger share of whatever market index they may be included in. You commented on tech stocks. So certainly we've talked about the 10 largest names. What's also interesting is of those 10 names, 8 of the 10 happen to be in the technology or technology-related sectors. So investors not only have very large company concentrations, they have an even larger sector concentration in their investment exposure. And it's done well. That's why we're at the point we're at today, because those stocks have outperformed. But the concern would be if the market tone shifts and technology stocks start to lag the broader market, they're going to investors will experience an outsized downturn as well. So that's probably something people should be thinking about, because I would suspect a lot of investors aren't aware of how concentrated those investments are right now.
So this is kind of, I'm getting historical parallels here. I suspect this is not the first time we've seen a concentrated market. I'm wondering if you could put today in context, how unusual is this kind of narrow market compared to history?
Yeah, certainly concentration levels ebb and flow over time. And there are periods when it expands more than other periods. This is historically extreme. We're about 40%, as I said. The previous high, as best as I could tell, was about 25% for that top 10, making up the exposure.
Okay, so this is unusual.
This is highly unusual. And frankly, there's no signs of it dissipating anytime soon. So because even though we're at 40 today, there's a reasonable chance it continues to go even higher from here.
When we've had a concentrated market in the past, kind of what forces have dissipated that phenomenon? What has kind of brought us back to baseline when we've seen this before?
Yeah, there's really 2 themes, I think, that cause that to evolve over time. One is simply time, right? As time goes by, the largest companies tend to evolve. Whether that's from smaller companies growing in size and taking a new spot in the top 10, or those existing companies shrinking in size and dropping out of the top 10. A question for you, Sarah, to turn the tables a little bit. If we went back 10 years, how many of the current top 10 would you guess were in the top 10 in 2015?
Oh, the trivia portion.
Yes. Yes.
I would say I'm going to say less than half. I'm going to say it's a different group of.
You're right. There were 4.
Okay, wow.
So 4 of the 10 largest today were also in the 10 largest 10 years ago. Now, if we went back 20 years, 2 decades, what would your guess be?
I'm going to guess none.
One. Microsoft was the only one that was in the top 10 in 2005. That's still there today.
Okay.
So we could debate if 10 years or 20 years is a long time in an investor life cycle. Maybe, maybe not. But still, to have that much turnover every decade is still quite meaningful. So the biggest shift was from 1995 to 2005. It turned over completely. And that was because we had the tech boom in around 1990, beginning around 1999.
Those are the Ciscos that we don't see.
Exactly. And a lot of the more traditional names like GE or Eastman Kodak that used to represent very large shares just declined in market value and were replaced by those new tech names. So the point I'm making is that whatever the next technological shift is, that will certainly cause some turnover in that top 10. But it does naturally ebb and flow as the calendar rolls forward as well. So fair amount of turnover from decade to decade.
Okay, so this brings me to a question that I think is on a lot of people's minds, and you mentioned it, which is about indexes.
Mm-hmm.
So, you're mentioning the turnover of the companies in the top 10. The index will turn over on its own for investors if you're a buy and hold investor over decades, right? But, what is the risk of concentration for index investors? Because I know it's there.
Sure. The risk is that you have outsized moves based on a small number of companies or a sector, like we said. What's also concerning is investors may build a portfolio. Think of your 401k account, for example. Maybe you own a broad market kind of S&P 500 diversified fund. Maybe you also have a growth fund to try and get some upside. One of the index providers I looked at, the top 8 names in their broad market fund were exactly the same as the top 8 names in their growth style
fund,
and their growth style index. So investors may be attempting to get diversification by holding funds in different categories, and they're really not because there's so much overlap from these large names. So the risks just keep becoming more and more concentrated as these names take up a bigger share of the index universe. So even people that think they're trying to minimize that risk may not actually be doing that.
That's interesting. So you could be a growth investor even if you only own the broad index.
Not by choice.
Or a
Correct.
tech investor.
Correct.
Not by choice.
Wow. Right. Which, as you alluded to, has done very well the last few years, but at some point it won't. And those investors will probably be surprised at the downside they experience.
Right. Yeah. So this is to me kind of the crux of the question right now, because we've seen the tech boom, we've seen the concentration kind of ramp up over the last couple of years. And these warnings are not new, right? It's not breaking news that the market is getting more concentrated. And the stocks at the top of the index, those top 10, top 8, are performing really well.
Sure.
They're putting up results. They're putting up earnings. Why are some strategists saying that, they're not as worried about this? And, what should investors think here?
Yeah, I think we view that question more as maybe it's good, maybe it's bad going forward. We don't know. Our recommendation is always for investors to consider better diversification. More diversification over the long run typically serves them well. And we've been recommending, and actually in our investment products doing some of this, is we're diversifying away by adding small cap exposure in the US and increasing exposure to global stock markets to try and broaden away from the highly concentrated US companies. So we've talked that the top 10 names in the S&P 500 are about 40% of the name. The top 10 names in the small cap index are only 6% of the index universe. So it's a much more diversified exposure. And it's also focused, it's also broader across the sector landscape as well. So adding things like more international exposure and additional small cap exposure are ways for investors to reduce this concentration risk.
So those are strategies you can use.
Absolutely.
In your portfolio.
Absolutely.
So the logical follow-up to me, sitting in the investor chair is saying, well, my S&P fund has done amazing. I don't want to leave that upside on the table. How can I balance, finding a little more diversification in small caps, which have, worked a little this year, but not, not historically, with, how do I get the protection and the upside at the same time?
Yeah, no doubt. I mean, that's the trade-off, right? It's just a classic risk-reward question. It's done well. Again, we don't expect it to necessarily reverse in the short term, but at some point it will reverse. And taking the steps I just talked about could help reduce your downside risk then. But there's nothing that says it can't go on for 2 more years as well. So I wish I could tell you when you should pull the lever and broaden the exposure out, but I don't have that answer.
Yeah, I guess we'd have different jobs if we knew.
Absolutely.
We knew that.
Or no job.
Right.
But yeah, I think, we feel it's our responsibility to present those other alternatives to investors. If they choose to do it, that's their own choice. They should always align their investment decisions with their time horizon and risk tolerance. But at the end of the day, I can't tell you if it's going to continue to be a good thing or a bad thing.
Absolutely.
My goal is just to help raise awareness of it.
Yeah, nobody has a crystal ball. That's a phrase you hear a lot. And I think you hit it just now. But if there were one takeaway for investors on concentration risk and how to think about this and how heavily weighted those big tech names are, what would you tell them?
Yeah, awareness is the word that comes to mind, Sarah, and that comes through both looking at the funds you own. Understanding what's in those funds, right? My example of the growth fund and the broad market fund having the same top 8, again, is not something I think investors would expect to experience. So just putting in a little time and effort to really understand what's in those funds that you might have in something like a 401k account, where you may think you did a good job by picking 6 different funds across the lineup, but if 3 of them have a lot of overlap, you haven't really accomplished much.
Sure. So know what you own and know what it's doing for you and why you own it.
Correct.
Great. Well, Dom, thank you so much. This was great. I was super glad to have you here.
Thanks, Sarah. Appreciate you having me.
That wraps up this week's episode. Thanks for making this show a part of your day. Couple reminders: you can give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Sarah Hansen, senior reporter at Morningstar. Take care.